Hi, hope you are staying safe and healthy. I'm Ki Chiling from Class D and Tutorial Group 5. I'm assigned with Unit 10, Question 23, Part 2, which is about the deductibility of expense or loss. Firstly, I would like to introduce the agenda of this presentation. There are in total 3 questions. For each question, I will first introduce the related law or principle. Then, I will briefly describe the question and go through the logical flow of analysis. Lastly, I would end the question with case law found, if there is any. At the very last part, I would also share some key takeaways related to these 3 questions. Let's enter the first question. Here, I would like to introduce Section 17(1)(c). Section 17(1) lists out the specific non-deductible items in profit tax. In this section, capital expenditure, loss, or withdrawal of capital is stated in Section 17(1)(c) to be a non-deductible expenditure in profit tax. Also, there are examples of other common items. Specifically, exchange gain or loss is not taxable or deductible if it's capital in nature. Vice versa is taxable or deductible if revenue in nature. Here comes the brief intro for question 1. Company A first received sales proceeds from a local customer. Then, they place it into a time deposit with a Tokyo bank in Japanese yen. After 3 months, Company A converted it back to Hong Kong dollars, and there was an exchange loss due to the fluctuation in exchange rate. Although the money was originated from trading receipts, its nature changed from revenue to capital when it was deposited, so it should be considered as a capital investment. Hence, the exchange loss was capital in nature and not deductible in profit tax under Section 17(1)(c). Commissioner of Inland Revenue, v. Li & Fung Limited, is a similar Hong Kong case law to the question, and hence legally binding. Its trading income was deposited in US dollar, so the exchange difference was capital in nature. It is not deductible because its income nature changed. In question 2, we have to know how to differentiate if the expense should be allocated to revenue or capital. The expense should be capitalized if it is made for an asset or advantage that brings enduring benefit to the business. Section 17(1)(c) applies here as well. A chief researcher is retiring from Company B. Company B made an agreement with him that a substantial sum of amount is paid. In return, the retired employee agreed not to get involved in any activities that may compete with Company B in any ways. Obviously, the agreement generates enduring benefit to Company B to eliminate potential competitors in the future market. The amount paid should be regarded as capital expenditure and not deductible under Section 17(1)(c). There is also a similar case law from UK, but not legally binding. It is between Commissioner of Inland Revenue and Associated Portland Cement Manufacturer Limited. The company paid 2 retired directors to not take part in any related business in cement manufacturing and selling. Due to the enduring benefit, the sum paid was capital in nature. In question 3, I would like to introduce Section 16(1)(d). To identify if the bad debt written off is deductible, at least one condition should be met. The bad debt should be included previously as taxable trading income, or the money is lent as a common operating transaction in a money lending business in Hong Kong. Company C made a large sum of loan to his supplier with serious financial issue. Unfortunately, the supplier went bankruptcy and could not recover the loan. His loan was then written off in Company C. Firstly, we should conduct a condition check. The loan was not recorded as a taxable trading receipt. Company C was not a money lending business too. Hence, the bad debt was not deductible, regardless of who is the borrower, unless there is proof to show that the company C is carrying on money lending business in Hong Kong. For example, money lender license and frequency of similar activities. At the end of the presentation, we understand that capital expenditure, loss, or withdrawal of capital is not deductible under Section 17(1)(c). Exchange gain or loss with capital in nature is not taxable or deductible. In opposite, it is taxable or deductible if revenue in nature. In Section 16(1)(d), bad debt is only deductible if it is originally a recorded taxable trading income, or money is lent by a money lending business in Hong Kong with proof provided. Here comes the end of the presentation. Thank you.